This is the Investor Connect podcast program. This is Hall T. Martin. I'm the host of the show, in which we interview angel investors, venture capital, private equity, family offices, and many other investor groups for startups and growth companies. I hope you enjoy this episode. Thank you for joining us. Well, hello, this is Hall Martin with Investor Connect. Today we're here with Brett King, author and speaker and founder and chairman of Moven. Brett, thank you for joining us.
I'm happy to be on the show. Thanks.
Can you tell us a little bit about how you got into the early stage world?
So I guess, I've been an entrepreneur for at least half of my career. I started up my own software business many years ago. I was still living in Australia. And then when the dot-com boom came along, I started a couple of dot-coms. It wasn't particularly successful at that, but really did get the bug for sort of prototyping, innovating ideas, sort of thinking of, sort of outside of the box about sort of disruptive technology. And in parallel to that, I, started sort of a writing career around how technology was disrupting financial services in particular. And that took me down the whole path. I started, most successful startup to date is the current, business I'm working with, which is a challenger bank, a neobank, which we founded in the US, in New York in 2011. And that's the most successful project I've taken from early stage through to production.
Well, you're also a venture partner. Can you tell us what groups you're working with and what they do?
Sure. So I've advised a bunch of different groups before. Core Innovation out of Los Angeles. Here, worked with David Rose at Gust and New York Angels. And then in the UK, Anthemis Group, which is a specialist fund focused on fintech investment. And then also worked with Apis Partners, which is focused on emerging markets tech, particularly at the moment in terms of banking and financial services in the African continent, but some in countries like India and Pakistan and so forth as well, where we see very rapid scaling emerging tech focused on the unbanked and underbanked in those markets.
Well, the fintech space is changing dramatically right now. What do you see are the major challenges coming up that think startups can address?
So I guess there's a couple of core themes here. We started obviously with customer experience, and a lot of people focused on reducing friction in the current system. But if you look at the faster scaling financial institutions globally now, many of them are startups, or that were once startups are now going concerns. Of course, the most successful of those being Ant Financial out of China, which was a spin-off from Alibaba. This is, in terms of the growth in mobile payments alone in China, it's been astounding. $17 trillion in mobile payments last year, which makes 190 million of mobile payments in the US look pale in comparison. But that does bring some interesting questions, which is, as technology becomes more and more embedded and allows banking to be sort of real time and low latency, how is that going to change the way we design interactions with customers around money, around investment, around credit access and things like that? Increasingly, what we're starting to understand is that you wouldn't take the model that we built around bank branches in the 1950s and 1960s and just adapt that for digital. That actually the real winners in this are those that really can sort of conceptualize a different experience where your money's embedded in your world through technology. So that's really, I'd say, if you're a startup today, look at those experiences. Don't try and iterate on the existing model. Look really to revolutionize the way people access money, move money, and so forth. And then really the second piece of this is around reforming the core of financial services. There's a sort of the back end, regulatory, reg tech and supervisory tech is going to be massive for investment over the next 15 to 20 years. So after we fix the experience, you get at the heart of it.
So given the regulatory nature of the financial services, how does a startup interact with that or deal with that? A startup with an app is not going to take Citibank down anytime soon, but what would be a better way of approaching it?
So, it depends on the market you're in. In the US, I think the current administration does tend to favor incumbents more. And so a lot of the initiatives we saw emerging out of the Obama administration, fintech sandboxes and the OCC fintech charter and so forth have been sort of put on the back burner right now. So that does require a heavier reliance on partnerships with existing banks to get stuff done in the United States. Whereas if you're in London or Singapore or China, you can be more aggressive about that. You can get your own license and charter that's a fintech specialized charter. You can sit in a sandbox. You can sort of navigate around existing regulations in that sandbox and get waivers from regulators and so forth to, do some pretty interesting and aggressive things. When you look at this systemically, it's interesting that the fintech boom, if you like, has sort of really only been around since, say, 2011, 2012. Obviously, you can predate a few fintech players prior to that, like PayPal and Square and others that sort of started in sort of 2008. But sort of in the common vernacular, it's been around for a while. And what we see is we're now starting to see some markets differentiate on the basis of their regulatory approach to innovation. And, when you've got some good sort of side-by-side comparisons, like, say, Hong Kong versus Singapore, what you had is Hong Kong resisted sort of the fintech thing and favored incumbents, didn't even allow P2P money transfers, didn't allow onboarding customers without a wet signature. It was quite restrictive in that respect. And so you had a market that was really in the hands of the incumbents in terms of innovation. But in Singapore, they were the opposite, extremely aggressive, really pushing hard for all sorts of elements of innovation. They're very early in making statements on ICO, on cryptocurrency. They're very early in terms of fintech licensing and sandboxes. And so you have a situation where over the course of 3 or 4 years, Singaporean innovation sort of outstepped Hong Kong significantly. And the incumbent banks were forced to really become very aggressive innovators as well. So DBS Bank is sort of a bit of the poster child of digital innovation or digital transformation of a traditional bank these days. But that's largely because of the way the regulator approached opening up early stage investment in fintechs to sort of create that innovation drive. Now you cut to December last year, and the Hong Kong regulator, realizing they're falling behind, has made radical changes to the regulatory structure to attract fintechs and startups into that marketplace, because they realized if they left it to the incumbents, that Hong Kong would potentially lose its position as an international financial center. So pretty interesting when you look at it on a macro level in respect to that.
Yeah, so there's also new technologies coming up like AI that will change the landscape and enable startups to go after this space. What do you think the impact of AI will be on it?
So obviously, AI as a whole is going to be one of the key disruptive themes over the next 15 to 20 years. I pick on sort of 4 large themes: artificial intelligence and robotics as a subset of that. You look at embedded technology experiences, how we just increasingly will live with technologies, ranging from like the smart devices we have today to AI personal assistants, augmented reality glasses and so forth. Health tech and gene editing is a big push, and then sort of smart infrastructure. So the way economies and companies will differentiate in the future will be based on smart value chains and smart infrastructure rather than the traditional value chains and economics we've had before. But AI has the potential to radically change the way we structure companies, and particularly the way we employ people and the skill sets we need to grow companies in the future. So in the United States, potentially 45% of jobs are at risk from automation as a result of artificial intelligence. Now, that's obviously over an extended period, but that means that we have to really start thinking from the ground up, from scratch, about how we reform the economy to cope in this sort of smart era. We need to train our children differently at school. We need to give them new skill sets, the stuff that we've got them in university for today. Think about people today learning accounting in a university. It's highly likely that probably 50% of those jobs will be automated by AI-based accounting software in the medium term, say 5 to 7 years. And so kids that are right now studying accounting in university could come out of that finding that their job's already obsolete. So sort of in respect to all of that, I think the adaptability of organizations and the adaptability of individuals becomes critical. In the financial services landscape particular, anywhere currently a human gives advice to another human, that is potentially at risk from AI, because I think that advice that is personalized and embedded in real time is going to become far more powerful, far more influential in your choice of services and how you choose a bank partner or financial services partner to work with than, hey, go down the office, meet this guy at a coffee shop, sign some papers, do a risk profile questionnaire, and get his recommendation on an asset class. I think that process is something that sort of grew in the 70s and 80s, but I think AI potentially can really disrupt that heavily.
And where do you think you'll see the initial disruption come in the system by AI? I've done AI myself, and it can be a difficult tool to apply, but where do you think it might hit first?
So right now, obviously, we're focused not on artificial general intelligence, which is AIs that can mimic humans, but we're really focused on machine learning capabilities. So where we're getting the fastest growth and capability right now is that ability to do pattern recognition, to learn human processes or human behavior and mimic that from a robotic process automation perspective. So whether that is scouring through emails or telephone conversations to find certain keywords or activities that would trigger an action typically by a human, where we can now automate that, or where it's something like looking at risk from a behavioral perspective. Fraud related, for example, is very big right now, where we can, over a period of time, measure you as an individual based on your behavior, the things you do, where you go, where you buy stuff, where you travel to, how you transact, what days of the week you tend to go shopping or spend money on. And that becomes an individual fingerprint for you. So when something out of character happens, when someone logs on from a different country into your banking app and we know you don't even have a passport, then that's a fairly good indication of fraud. So rather than having to deal with that in the typical manner, which is we try and protect it through passwords and two-factor authentication, we now can trap it at the source based on behavioral models. So that sort of stuff is what I find really, really interesting. And it's something that we can't do efficiently with humans in the process right now. So it's not necessarily going to displace humans, but it will make the services used safer and better for you.
What do you think about blockchain? That's the other big technology that's coming up that has a great potential. What impact do you think blockchain is going to have on the space?
So obviously, the way we think about financial services today on something simple as, say, cross-border payments, we have a pretty convoluted process right now for enabling you to send money overseas. So what you have to do is you have to register and open a bank account. You have to jump through all this hoops, this KYC, know your customer regulations and so forth. Then you can make a deposit in a bank account for a purpose to send money offshore. If you haven't sent a wire transfer before, for many of the banks in the US, that's going to raise a red flag. Your account will be defrauded or flagged as a potential fraud because it's not something habitually you do. And then finally, when you do that, you send the money offshore, you've got to have all this detail. What's the person's bank account number, the sort code or the SWIFT code of the bank that they're using at the other end? We make it extremely time-consuming and difficult. There's a sort of running joke in the blockchain community that it'd be faster to get on a plane and fly from London to San Francisco with a suitcase full of money than it would be to transfer through the traditional banking system. So when you look at something like blockchain's application in that, we could have zero-proof models where we don't need to know who you are particularly for doing some basic transfers. If this becomes a thing that you do on a regular basis, then we're going to need to understand your identity then, but we can build that progressively. Secondly, you don't necessarily have to know what bank account the person has at the other end. As long as you have some form of identifier that's unique to them, their telephone number or an email address, then you should be able to just send money to them instantly from anywhere in the world, and then at their end, then be able to sort of deal with that. As long as that information is immutable and can't be hacked or messed with, then that system would work independent of all the banking pipes and rails that we have right now today. So this is a sort of an example of where blockchain could be used and is being used with Ripple, R3 Consortium and others to sort of tackle trade finance and cross-border. But the other areas that are interesting is IoT commerce, have a self-driving car with its own bank account. When it's driving on the road, it's got to pay road tolls, road tax, pay for electricity, a supercharger potentially. And then it might be logged onto Uber for a few hours to drive and get paid for that. So, you're going to have commerce that isn't attached to a human that owns a bank account necessarily. And that sort of stuff, at this point, the existing banking system just couldn't handle. We'd need something like blockchain to do.
And so with IoT, we've talked about cars that have the payment tools embedded inside of them. Where do you think we'll see that show up first? Obviously, with car driving up to a pump to pay for gas would be an ideal spot for it, but where else do you see it coming in?
So one example I like to use, which is a really good example of blockchain overall, but specific terms to your example, and it's also a good example of what I call a really constructive ICO token issue, is a company that is got a presence in the Middle East, Africa, and so forth, doing solar panel deployment. So they're a company called the Sun Exchange. So they deploy solar panels. You can buy a solar panel to deploy in a village in Africa, for example, using Bitcoin. You can use USD as well to do that. But then once that solar panel is deployed, for every megawatt of energy that it produces a token. And they came up with such a good name for the token. What would you call a token for a solar company? Well, they called it a RA, which is, I thought, a great name for their token. So the coin or cryptocurrency that's generated as a matter of electricity generation on those solar panels is generated on the blockchain, and it's called a RA. It's a crypto coin. You can trade that for Bitcoin, or you can reinvest it in more assets, more solar panels to deploy elsewhere in the region. The solar panels themselves are managed on smart contracts on the blockchain. The company is highly automated in respect to how it deals with all this, but that's a really good example of utility-based value exchange or utility-based tokens built on top of the blockchain that, it's a pretty revolutionary way of thinking about energy production and the value produced by a generation facility.
Well, there's quite a few changes coming up through these technologies, AI, blockchain, and IoT commerce. In the last few minutes that we have, what else should we cover?
Well, I'm about to launch my 6th book, which is called Bank 4.0. And that comes out in August. It's a series I started in 2009. My first book was actually called Bank 2.0. I did Bank 3.0, but in between there, I've done some other books as well. Augmented Life in the Smart Lane was my last book a couple of years ago. It was called out by President Xi in his national address in January, so we got quite excited about that. But in Bank 4.0, I tried to look at the emerging trends that were really going to change financial services. Now, you made a comment before. You said a startup coming into the market is probably not going to take Citibank down anytime soon. And historically, that's sort of the way we've tended to view disruptive technologies like that. But if Amazon has taught us anything, it's that when Sears and JCPenney or Borders, when they first saw Amazon came out, they said exactly the same thing. It's not going to take down Borders or Sears or JCPenney anytime soon. But 15 years later or 20 years later, then the view looks quite different. So I think if you try to predict where we're going with this, what I was looking for is what is a measure of disruptive innovation that could do the most damage to the incumbent market. And when you look historically at the biggest innovations that have changed the world, things like the automobile, the steam machine, the printing press, these tend to be first principles design thinking, where sort of start from scratch in terms of the way you build out. And then the whole industry changes as a result of that. We saw it happen with the iPhone. Every phone after the iPhone launched essentially became a clone of that sort of smartphone model. And when you look at financial services and banking, we are starting to see out of places like China very, very different ways of thinking about financial services, which are scaling much faster and are much more profitable than the way we run banking traditionally. And I think that is the start of something extremely disruptive. So the subtitle for Bank 4.0 is Banking Everywhere, Never at a Bank.
Well, certainly that's where it's going. The world has gone mobile. The world has gone out from the centralized place. And so banking everywhere certainly makes sense. And then it'd be interesting to see what happens to all those physical banks on every corner. Where will they go? And how it will change. How fast do you think that change will come in and take place given the regulatory hurdles that have to be overcome in order to put that into place. Today we have KYC, AML, and all this regulation that we have to deal with. But when do you think we'll actually see those corner banks disappear?
In the US, there's been heavy consolidation in the market over the last few years. Since the mid-90s, the concentration of assets meant that the top banks in the US held about 20% of deposits. Today, it's closer to 65%. So we're already seeing consolidation in the market where smaller banks are having to merge and consolidate. And we hit peak branches in 2008, and that's been declining every year, about 2 to 3%. The majors have reduced their branch square footage by at least 20% since 2008. So the consolidation is already happening. The real question is sort of what's the end state? Obviously, there are going to be some banks that will make the transition, primarily becoming sort of digitally focused. And sort of the key warning, the canary in the coal mine, I think right now are two things: ROE, return on equity, and customer acquisition technologies. So, you have the challenger banks. There's about 80 of those around the world. And the average ROE of a challenger bank is about between 9 and 17% right now. Whereas for traditional banks in the US, the best banks are sort of 3 to 4%. And then acquisition cost, we see startups can acquire customers digitally direct at sort of $5 to $30 range for that. Whereas, it costs Chase today, $350 on average to acquire a new checking account customer. So that's where the battle has been fought. It's been fought in the core economics of banking. And even with the regulatory support, the end result is, if you look at the US right now compared with, say, China and the mobile payments landscape, this has forced China to become cashless in urban centers almost overnight. And yet in the US, we still write checks, still have heavy cash use. So I think it's going to become fairly obvious from a regulatory perspective that markets like the US are going to have to accelerate their innovation to stay relevant on a global basis. In terms of timescale, look, I think you'll have some majors in the wealth management front become one of the largest asset managers. I think that'll happen in the next 5 to 7 years. I think challenger banks are already starting to acquire banks of their own to grow more aggressively. So I think it's already happening, but by 2025, I think you'll clearly see a different makeup of the market in terms of market share.
Well, I agree. It's happening now, and we're reaching an inflection point where it's really going to start to show up physically on the street corner. I think it's starting, like you say, now decreasing a little bit in the number of banks, size of banks on the physical presence. And you see apps and other tools out there, but it just seems like the turning point where it really, now we start shutting down a lot of those banks is coming up very soon. So it'll be interesting to see when that actually occurs, but I think you're right. I think it's coming up very quickly. But I want to thank you for taking time today. How best for the audience to get back in touch with you?
So if you guys are on Twitter, you can catch me at Brett King on Twitter. That's with 2 T's. I'm also, if you search on Brett King Author on Facebook, you'll see my page there. Or check out brettking.com, which is my bio page. And also check out moven.com, which is the startup or challenger bank I run out of New York.
Great. Well, those are the show notes. Appreciate you coming on and hope to have you back for a follow-up in the near future. And looking forward to seeing how these technologies play out.
Thanks all. Appreciate the time.
Investor Connect helps investors interested in startup funding. In this podcast series, experienced investors share their experience and advice. You can learn more at investorconnect.org. Paul T. Martin is the director of Investor Connect, which is a 501c3 nonprofit dedicated to the education of investors for early-stage funding. All opinions expressed by Hall and podcast guests are solely their own opinions and do not reflect the opinion of Investor Connect. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions.